Mayuresh Joshi, Head of Equity Research at William O'Neill, is with us on the show now. Mayuresh, what have you made of Accenture's numbers that were reported yesterday? What does it spell for the Indian IT companies? And are we likely to see EPS downgrades in the upcoming earnings season? And is there any risk to the companies like not meeting their full year guidance that they've given, at least the ones that have?
Afternoon, Rima. Accenture's numbers are a little bit softer than expected, both in terms of the margin guidance that they have given and the expectations in terms of revenue growth in constant currency terms. Having said that, since Accenture mirrors a lot of our IT companies in some terms of the outsourcing model, a lot of the large cap IT companies probably started feeling the heat yesterday. Tech Mahindra case in point, which corrected quite significantly yesterday. Though the opportunities are pretty large structurally over the next few years in terms of AI, cloud computing, and the sheer size is expected to grow at a pace of 15%, 5% in terms of data center growth, 15% CAGR in terms of cloud computing, and in fact, more than 50% in terms of the 5G ecosystem itself. I think the short-term pain points, Rima, are probably here to stay. A large element in terms of the multi-million deals that a few companies like HCL Tech, TCS announced, I think that should largely be a part and parcel of the overall order wins that they were expecting for the better part of this financial year. And if the soft landing situation persists in the US markets, specifically when it comes to the fourth quarter of quarter one in their context in terms of order firming, specifically large orders, and if they get delayed or deferred by a few quarters, it does pose an upside risk in terms of the revenue guidance for the second half and for the first half of the next financial year as well. Having said that, valuations of large cap IT companies have probably come down to a large extent. Mid cap IT companies still seem to be outperforming as we speak, both in terms of pricing pressures not being evident from management commentaries and expectations of revenue growth staying extremely stable going forward. The only aspect in terms of valuations being through the roof and late stage basis for mid cap IT companies can make it a little bit more susceptible if revenues do not fall in line in terms of market expectations. So we're largely having a market performer call for the sector as well. It will largely depend in terms of how the first set of numbers start turning out and what take the management probably gives us in terms of the macro environment as far as the US and the European markets are concerned.
Okay, well, Mayuresh, I wanted your thoughts also on what the way forward could look like in terms of stocks that we should watch out for. Any big triggers that you notice? There's, of course, auto sales that's coming up, so those stocks are in focus. There's the World Cup that's coming up, so there are, of course, all these travel-oriented, platform companies in focus. But where are the stocks where you see both valuation as well as growth comfort?
Afternoon, Sonia. So I think out of the select pockets that we are probably tracking, paper stocks are probably looking a little bit more attractive as we speak at this point of time. If you probably look at the construct of the sector as a whole, the deficiency in drains will probably drive out a lot of unorganized players who are largely dependent for their water needs in terms of the natural rainfall, all the resources that they are dependent on, and even the power needs. So the integrated players within this vertical itself can benefit quite significantly. Players like a West Coast, Andhra, JK should have significant accretion. Festive season coming around, so a lot of demand in terms of packaging boards, specialty paper, writing paper. And therefore, I think that the expectations in terms of price hikes coming through, and a large part of these price hikes, even if these companies take for the industry of the sector as a whole, because input costs will be minimal because of their vertically integrated operations, the performance in terms of numbers will be relatively better. They've had a stellar show last year. Our expectation is that it should probably continue as we head into the next few quarters as well. Auto ancillary, Sonia, a space that you closely track, also should continue doing well. I think the entire theme that we are speaking about in terms of the EV ecosystem transition, a lot of players are going to be key beneficiaries in the next few quarters. Rollout across products, platforms expected by a lot of OEMs across two-wheelers, four-wheelers, and even the commercial side in the next few quarters as we speak. And therefore, auto ancillaries which are transitioning to this part quite successfully over the last few quarters should continue doing well. So our take is that stocks like PM Industries, as an example, remain on our buy watch list. Excellent product profile that they probably have, excellent margin profile as well, and the expectations of a very stable growth going forward will probably mean that this company stays instead. Even the battery makers, something like an Amara or an Exide, should continue doing well because of the additional capacities they're probably building up. Something like a Minda Industries as well, which has done well. Somebody can definitely hold on to this stock. And therefore, auto anchors and paper stocks as a space look interesting from a growth and a value perspective.
We had a chat with JK Paper just about 10 days back, and they get about 40% of their revenues from the office paper, the supplies that you need. And they said that the office paper demand is very strong. It's back to pre-COVID level. And the recent news flow, like TCS calling all their employees back to office, is only going to boost the office paper segment demand. So auto ags and paper, that's what Mayuresh likes.
Mayuresh, RR Kabil, I don't know if you have looked at that name, cable and wire company, exposure to the FMEG segment as well, fans and other electrical goods. Now trades at, I was just looking at the numbers, it trades at 80 times, no less. When it came to the market, it came at a premium as compared to your Havells or a KEI or others. And over the last 2 days, yesterday was a big day, today is a bigger day. It's now gone up to almost 80 times. FY24 earnings, by the way. Your thoughts?
Absolutely, Prashant. No, absolutely. I think the move that the RR Cable has over the last few days has been exponential, to say the least. And therefore, valuations have definitely gone through the roof. In fact, even all its peers within the wires and cable space, look at the sheer outperformance that stocks like Polycab have done over the past few months. Obviously, numbers that came in the past quarter have been exceptionally good. The commentary surrounding the entire space itself is very, very encouraging, both in terms of housing demand and the expectations in terms of a lot of export opportunities that can come their way. The KEI management as well sounded very, very optimistic on both these counts. And therefore, volume/value growth was expected to continue at a very reasonable pace over the next few years. So I think most companies within the space itself, KEI, Polycab, RR Kabil, have probably shot themselves up as far as price action is concerned. Valuations are through the roof, trading at late stage basis as we see at MarketSmith, and therefore pullbacks on stock like a KEI, Polycab, even an APAR, for example. I think an exceptional move there as well is definitely warranted. No fresh investments at these levels. Pullback is the only way that you can probably look at this.
Mayuresh, thank you very much for joining in. Enjoy your long weekend.